Hi, Savijit Chatterjee, recording our weekly session for Chartsarefun. This is for the week of July 21st, recording this on July 27th around afternoon, 4 p.m. Eastern. This week, the week coming up, we know that there's FOMC meeting that's on July 30th. Everyone's waiting patiently to hear from Chair Powell and the FOMC team regarding interest rate decision. And then we also have the deadline. Hopefully, this is the third and penultimate deadline on the tariffs. There's not going to be any of the taco that phenomena that people expect. So those that are not able to negotiate deals, it'll be interesting to see what tariffs they end up. But this might be the August 1st final deadline. There have been recent deals with Japan at 15%, and then Euro just signed today, this morning, at 15% as well. We look at some speculative activity in the market picking up. We've been cautioning that the market has come up a lot, needs a breather. We know that in the last couple of weeks, there's been a lot of speculative activity. SPAC IPOs kind of trending higher this last few months. And also, if we look at meme stock phenomena, we look at three key stocks with respect to meme phenomena, whether it's the Kohl's, the age-old retailer, Open Door, and then Krispy Kreme donut. So we look at some of the charts. We look at a very bearish pattern forming on the NASDAQ 100, one of the strongest ETFs called QQQ. Some key earnings are coming up this week on the tech front. We did already have Tesla and Alphabet, but then we've got Amazon, Microsoft, and Apple, all three big ones announcing, and Meta announcing earnings this week. So we'll see what QQQ chart is telling us. This is called a rising, it's a bearish pattern called a rising wedge. We'll see what the pattern, tends to do from a stock Chartschool article, and then look at a similar kind of formation that had happened in the Meta chart, what it did after that, and going into earnings, what Meta chart looks like. And then we'll talk about two of the deals that happened. One was Japan, of course. So the Nikkei, we look at that chart. Nikkei is the Japan's index. And then with the Euro deal that just signed, look at the impact to Bitcoin that we know trades 24/7. So we'll look at the Bitcoin chart. So this is our website, substack.com, chartsarefun.substack.com. We appreciate you subscribing to it. When the blogs come out in the mornings, if you share your email, it'll be emailed to you. And then our YouTube site is also Chartsarefun. This is the channel where we post weekly videos, and appreciate you subscribing to the channel. And if you like the videos, if you could hit the like button. Want to start off with Suburbandrone. This is a ex-poster. He posts quite regularly. In many ways, you could call him a perma bear, but he is extremely pragmatic. He, as you can see, a Bachelor of Finance with 30 years trading experience. He's been cautioning for quite some time, and this chart that he shows here is an interesting notion of a bubble. If you take the entire S&P 500 index and take all the 500 stocks and do a price to sales ratio on that, that's currently hitting a peak over the 3 level. It's near almost 3.2, way higher than what we saw during the post-dot-com period in the early 2000s. That used to be in the 1.5, 1.6 level, shot up in 2021. We know that after the COVID extreme liquidity coming in, that's when some of the SPACs were also out there, shooting up like no tomorrow. The market had shot up sharply, the 2021 peak in this price to sales ratio. It drastically dropped in that bear market we saw in 2022 into 23, and then now it's back higher highs, closer to 3.2. So he's cautioning that, you know what, this is bubblish kind of phenomenon. If you look at price over sales, entire S&P 500, 500 blue chip stocks, 500 top market cap stocks projecting together a price sales over 3 seems quite bubblish. Barron's article talked about an interesting Fed phenomena. This has not happened in 30 years, since 1993. This is with the FOMC, Federal Reserve governors, and the various regional Federal Reserve banking chiefs voting on interest rate cuts. As we can see, this curve here shows us the interest rates. It was at 5.5 for most of 2024. This is after Fed had increased the rate significantly from below 0.5% to 5.5. So 500 basis point increase. And then from there, We got 3 cuts in 2024. The first 50 basis point cut we got in September, then the next 25 basis point cut in November, and a 25 basis in December. At that level, which, we brought it down to 4.5. We've been hovering flat in that space now for almost from December to now, end of July, 8 months. So now moving ahead, if you look at the dot plot, this is what Fed publishes quarterly into March, June, and September and December. So in the one that was published in June, the dot plot, as we can see, projecting for 2025, these are the dots. Almost 7 of the Federal Reserve members expect rates to remain unchanged, not just for the July meeting, for all of 2025. As in 7 of them think, at least at the point when they had to put their plots on the June meeting, that it'll remain at that 4.5 level for the rest of the year. So that shows a lot of hawkishness, concerns about the tariffs, concerns about rate cuts as a result not being needed. Economy seems to be doing quite well, and hence 7 such dots. Only 2 dots that we see here on the bottom expect a rate cut of 50 basis point, bringing the rate down from 4.25 to 4.5 level to towards the 3.75 level. So that's what this article talks about, that there are only 2 projected 3/4 point cuts, actually, 2 projected 3/4 point cuts. So that means 75 basis point cut from a 4.5 brings us towards 3.75, and that's what we see here. The level here is at wherever the line is, the dot is above that. So it's slow. We can see here that we have 4, we have 3.5, and then that's 3.75. So we can right now see that there's about 2 that expect a 75. So this is 25 basis point. The next line is 50 basis point. The third line is 75 basis point. And the one on the top is unchanged, rates remaining the same as where they were. So 7 of them expect rates to be unchanged, while the just 2 of them expect a 75 basis point cut. Now, 10-year yield, which is long-term, it's not directly determined by rate cut. It's dependent on what the bond market thinks of the economy, how well it'll do, whether it'll heat up or inflation concerns. That's showing us a pattern called inverse head and shoulder. It could kind of be deactivated, or it may not pan out. But at this point, there is inverse head and shoulder neckline at 4.5, a left shoulder from 4.5 to 4.31, back to 4.5, a head to 4.2, back towards 4.5. Recent test of kind of 3.28, so 4.32. And then if this breaks higher, that measured target is 48 or 4.8%, which was last tested in early January of 2025. So that's something we need to look into. We are thinking that perhaps with the Fed meeting this week, we could see some form of not as dovish as President Trump and others wanted to believe. Remember, 7 of the Reserve members are actually leaning hawkish. If there is a hawkish stance from there, this 10-year yield could break higher, and that could mean we could head towards the 4.8%. Something to watch. Something else is corroborating with the rate or the 10-year yield increasing is the dollar. The UUP is the dollar ETF against American basket of currencies. That's also beautiful inverse head and shoulder. The neckline is at 27.5. The left shoulder and right shoulder are identical at 27.05 and the head at 26.8. So 26.81 to 27.51, you're talking about 0.7 as the depth of the head from the neckline. Add that to the neckline, 27.51 plus 0.7 takes us to 28.21, which is not too far from the 200-day moving average at 28.23. So we expect dollar to have a counter trend rally. We know that the dollar has been very bearishly coming down the entire year. From January at 29.9, it tested a low at 26.8 towards early July. So the dollar has come down a lot. And from this level, we expect a counter trend rally, a counter trend reversal higher from this inverse head and shoulder. So dollar reversing higher and a 10-year yield having higher yields could in some ways mean a stock market pullback. So that's something we think could correlate, and hence we are getting prepared for that stock market pullback. And I'll show you more of what are the technical indicators of that. Talked about SPACs. Often the last part of a rally, speculative investing, trading increases. This is a multi-year chart of SPAC IPOs, and we can see this is from SPAC Research, that in 2021, there was a huge number of IPOs, from 248 IPOs to 613 in 2021. Since then, it has collapsed, 86. That's how that typically happens when liquidity collapses. Money chases not the SPACs, but the high yield treasuries, because those are safer money to invest in. But now with rate cut expectations, we had 3 rate cuts last year, 75 basis points of cut last year. SPACs from 2024 into 2025 are now heating up. Market thinks that perhaps rates are not going to be as attractive on the treasuries, and perhaps equities might be a better place to invest in. So we have see here, we saw 57 IPOs in 2024, and in 2025, 74 IPOs. 74 to 31 is more than double of the IPOs we saw in the bottom in 2023. So IPO interest is shooting up. One big poster child of a SPAC IPO was Webull that happened in the mid-April timeframe. That IPOs typically kind of start off at $10. Look, from 10 it went to 79. From 79.5, it has just drastically pulled back. Part of this is a brokerage firm, a lot of expectation that they are big into crypto trading and so on. So there's a lot of speculative money flowing into Webull, not a profitable company, tremendous amount of expectation that the younger crowd will be investing in this brokerage service. But we know that the leader in this space is Robinhood, way ahead of any of the others. And another fintech investor in this space is SoFi, bringing in interesting trading opportunities as well. So Webull is, distinctly behind those. But as you can see from a SPAC, how these sharp meme kind of shoot up happens and then collapse happens right as people start moving money out. From 79 collapse to 13, touched as recent as the 10 level. 10 is where SPACs typically at the base value. So it stayed 10 for multiple days at a time in June. Recently, it shot up to 15, pulled back to the 11s, and then last week shot up to 18. So this kind of SPAC interest, and then with meme interest in companies like Kohl's, which has quite a bit of debt, does have retail stores out there, not doing so great with respect to the overall brick and mortar retail business that they're in. Let's look at how it shot up from. This was in the news. Some big hedge fund investor has initiated position on it, but they were really trading this in and out, not so much of activist investing interest and so on. But that from a $6 stock went up to 21. Since then, did pull back. Each candle is a day of trading. So the last 4 days, a lot of volume. In fact, the day it pulled back, 200 million plus of volume when that had shot up. But it did look at when you get a dark black candle, it means it opens higher, closes a lot lower. It was high up for the day, but that's kind of bearish distribution going on throughout the day, leading the price to come a lot lower from where it opened. So it opened near close to 20, near 19.7, and closed near 14. $5 of distribution through the day with heavy volume people kind of selling shares, and it's a lot more selling interest than buying interest, causing that kind of a black shaded candle. Next couple of days were also heavy selling, and Kohl's is one such meme stock. Another one, very similar kind of a chart, is Open Door. This is in the real estate business, app for real estates, and sellers trying to sell their own homes in a much faster fashion than the traditional way of brokers selling. Here you can see that it was a penny stock at 50 cents, shot up towards to $5, pulled back to $2, and since then it closed at 2.5. But this kind of speculative meme-like trading, such a from 0.5 going to like a 10x kind of a move, is concerning. And same thing with Krispy Kreme donut, also kind of a $2.5 double to more than double to 5.7. And then the last couple of days, volatility, a lot of price movements, got cut in half from 5.7. Not half, but almost from 5.7 to $4, and closed in 4.42. We may see a couple of more of these, but with the FOMC decision on the 30th coming up on Wednesday late afternoon, we are getting concerned. Now moving on to the accumulation, the advanced decline line, which is the market breadth. The New York Stock Exchange AD line, and this drawn in a cumulative fashion where you take every day's advanced decline, add it to the previous day, and then draw out a cumulative line out of that. That cumulative chart is showing a negative divergence in RSI. We can see that as NYAD has been climbing from the April lows all the way up to recent July highs, the last week, couple of weeks in July, in fact, the entire month of July, RSI is printing lower highs. That indicates a topping pattern in the market breadth, and that indicates potentially a market pullback coming. Same thing here in MACD, just like we saw in RSI. RSI printing lower highs, MACD printing lower highs, indicating the market breadth is deteriorating, signaling early signals of a market pullback. So if you look at S&P 500, that has an interesting inverse head and shoulder. There are many ways to plot patterns on this, but if you use that 5,700 as a neckline, the left shoulder here in late March, they head into 48.35, the April 7th low, 5,700 again, the neckline, a pullback in early May. That breakout, so from 48.35 to 5,700, you're talking about roughly 865 points. Add 865 to 5,700, you get 6,565, 6,565. That's the target for S&P 500. We are close to 6,400, 6,395. You're talking about another 165, 175 points or so left on this rally. And that we could perhaps get in the next few days, but we are reaching a key level from terms of this inverse head and shoulder that S&P we need to watch out. And overall here as well, RSI did recently, it was printing a negative divergence, but recently printed a higher high on RSI. But MACD, as we can see, still lower than what we saw back towards the mid-May timeframe. And we can see that the histogram on the MACD has been flattening, pretty much not showing much movement. And so it's kind of moving up with a lower kind of declining momentum, as a result of which MACD isn't moving, shooting up much higher. And look at how far it's diverged from its 200-day moving average, which is below 5,900 at 58.86. With that kind of a divergence of current S&P from the 200-day, like we saw back in February, like we saw back in December, calls for some form of a pullback, if not to test the 50-day and maybe deeper to test the 200-day. Now, one key pattern that the Suburbandrone Twitter poster posted about is there's been now 65 closes in the NASDAQ 100, which is the QQQ index, above its 20-day moving average. When a stock or a ETF trades above the 20-day moving average, that's typically a bullish trend, a bullish phenomena. In the past, we've seen, like in the 2024, as high as maybe like we saw right now, 65. We saw somewhere about the 50 or so level we saw in 2024. And then it comes right back to zero as soon as all these, like in this case, the ETF goes below the 20-day moving average. And in the next couple of weeks, we expect this to come back to zero, as in when it will close below the 20-day moving average. And that could happen. Every time it shoots up, it gets an extreme overbought, very quickly it comes back to zero. It shoots up, extreme overbought, comes back to zero. So every time you get these sharp spikes, it's almost like a sawtooth kind of a pattern. You get back a pullback to the zero, and the zero happens when the QQQ in this case pulls back to its 20-day moving average. It's something to be concerned about. Now, a key technical pattern that's forming in the market is called a rising wedge. A rising wedge is a bearish pattern. You join the highs and you join the lows. That comes to a converging apex. And while that happens, you get a MACD. In this case, PPO is similar as a MACD. Percent price oscillator is the technical indicator. That prints a lower high, negative divergence, as this bearish pattern happens. And then a breakdown typically takes it down to where the wedge starts from, in this case, down all the way to this level here. And this is the stock of Dell. And we see another pattern here for Ann Taylor. We can see that this was a bearish rising wedge. Take the lows, take the highs, converging. It doesn't have to break down till the full convergence toward the apex, but similar negative divergence in PPO, and then a breakdown. PPO goes negative. price comes down, and then from there, the other key indicator to watch is you start seeing volume on the breakdown. So that's what you got to watch. We'll show a very similar pattern on the NASDAQ 100 QQQ forming the wedge. We haven't gotten the breakdown yet, and we got to watch the cumulative, the check-in money flow, which is the overall money, invested in this ETF. What is the money flow telling us? And the negative divergence. So here, this is QQQ validating the negative divergence. So we definitely see lower highs in MACD as we are coming to a point where this is literally coming to the end or apex. We join the highs, join the lows, they're converging to a point where we expect from here a breakdown. So that's a bearish rising wedge breakdown expected in the QQQ. We wouldn't be surprised to see it pull all the way down sharply towards 507, the rising 200-day moving average, but at minimum, level of breakdown towards the 538, which is the rising 50-day moving average, cannot be ruled out. Now, what is a measured target on this? Just like we showed on S&P 500, we can see a similar pattern here at the 490 level from 401. So 401.94 is 402. So 402 to 490 is $88. Add $88 to 490, that takes it to 578. We've touched 567.7 or 568, another 10 points or so upside in QQQ. So if S&P has a little more upside and QQQ maybe just to test the top end of that rising wedge towards that 478, could be an overshoot past it. But then from there, we see you can see that the check-in money flow is also showing negative divergence, a lot lower peak than what we saw in the May timeframe. And that has now started declining, which we would expect, like we showed in the pattern here, check-in money flow starts going negative once the breakdown happens. So that's something for us to watch. An early indicator of breaking down from a bearish wedge is Meta. Meta's earnings is coming up this week, but we can see that from that bearish rising wedge, it broke down. It broke down in early July. We can see check-in money flow is already negative. It's no longer at the strong positive that we had in most of May and June. It is now negative. We can see that it broke down with RSI at forming lower highs, and same thing with the MACD, a negative divergence, with Meta climbed from higher highs from near 700 to 747. We can see that the MACD was at a lower high. And then MACD since then has been printing lower highs. So that's a possibility. If you're looking at 691 to 497, that's roughly 56 points on the height of the head from this shoulder. And this could be a left shoulder. This is the head. That's the right shoulder forming. If Meta has any kind of earnings weakness with respect to it, they'll probably have a strong earnings, but maybe market expects even higher future earnings from them. But for any kind of weakness indicated from Meta, we can expect, we know that there's going to be huge spending. They've been gobbling up AI talent across the board from OpenAI, from Google, Apple, and so on. So Meta could be announcing high AI investments. You could expect capital spending to be very high on Meta, and that could perhaps make the market a bit nervous on the monetization of all that spending, and could break that down from a 691, as we said, 747 is $56. $56, and subtracted from 691, you're talking about roughly $635. And 635, 636 is where we've tested in early December. We tested 633 in the March, and that's potentially a little higher than the 200-day at 624 is where we think Meta could break down. So that's a head and shoulder. This is a classic breakdown from a bearish rising wedge, and we expect something similar to happen in QQQ. QQQ is held strongly because of NVIDIA, the largest stock in it, Microsoft, the second largest. Those are doing very well. NVIDIA's earnings doesn't come out till later in May, but at least Microsoft's earnings is coming up next week. Got to watch and see how Microsoft performs. If Microsoft does sell off, Meta sells off further, we can expect this to break down. So that's something for us to watch. And finally, I talked about trade deals. August 1st is the hard deadline for it. This is the Japanese stock market, the Nikkei index. This has a beautiful ascending triangle breakout or a cup and handle breakout from 30.8 to 38.5. That's roughly 7,700. 7,700 added to 48.5. You're talking about 46 42,200. That's where we think Nikkei is headed near term. We can see it tested 42,100 pullback on Friday, but with a little more additional upside momentum, this could climb towards that 46. Now, a longer term chart on the Nikkei index is a cup from 40.3 down to 30.8 to 40.9. So 30.8 to 40.9 is 10,100. 10,100 added to 40,900 is 51,000. So that's the longer term target on Nikkei. Even if we do get a pullback, maybe to retest that 40,000 level, we expect to climb up towards the 51. So Japanese market looks like a strong investing opportunity because of the trade deal in US. Perhaps there could be money moving in there, and that could help the Japanese stock market, something to look into. And the trade deal with Europe was just announced. We can see this picture between President Trump and the European Commissioner Ursula von der Leyen. They talked about 600 billion investment into various US energy defense purchases, and the tariff from 30% was slashed in half to 15%. That was the agreement. Steel and aluminum continues to be at the higher tariff of 50, but cars, pharmaceuticals, semiconductors are now at the lower 15% tariff. So market did celebrate that. That's the Bitcoin 24/7 chart. We can see that it broke out this last couple of hours from near the 118,000 level to 119. This Bitcoin chart is something we are watching as a leading indicator of what the market could do. We can see that the Bitcoin peaked earlier in the February 14 timeframe. Market peaks maybe 2 or 3 weeks later. Maybe next week the market peaks, but Bitcoin from that peak did pull back quite a lot, 123 to 116.2, 116.3. That breakdown from 123 to 116 measures down towards 109,000, 109,200. That's the measured target on this. It hasn't quite gotten that far. It did break down towards end of last week towards 114.8. Quickly tried to recover, but we do see a bearish cross of this is a 2-hour chart. Every candle is 2 hours. We know it's 24/7, so 2-hour in this case is showing us back towards from July 7th or so, from that week onwards. But we can see here that this chart has a bearish cross of the 50 period below the 200. 200 is kind of plateauing out. There is now a negative trend. Initial rise that we saw from the EU tariff is given back a little bit. It has been pulling back below the 119 to the 118. We'll see where it opens tomorrow on Monday, but if Bitcoin does continue its decline, that's a leading indicator of the market coming up with its decline, finding its peak, like Bitcoin found its peak at 123 for the time being. Market could find its peak. Maybe in summing it up, QQQ's peak could lie somewhere around the, as we said, if you measure from 490 to 402, that's 88 points. 88 to 490 is 578. So something out of this bearish rising wedge, it could break down. We can see indication of money flow showing negative divergence, lower highs in money flow, lower highs in MACD. That's what a rising wedge is supposed to do. The momentum indicator has a negative divergence, so does the money flow goes negative, and we've seen that in Meta's chart already. Meta broke down from its rising wedge pattern, now potentially is forming a head and shoulder topping pattern. If Meta's earnings is poor this week, expect to break down below 691, taking it down towards 536. That's where we think the target for Meta is. We are expecting 10-year yield to have a bearish move, because when bonds rally, in this case, bonds are not going to rally, they're going to sell off. When bonds sell off, yields shoot higher. So expect a bearish move in bonds, yields increasing in size from near 4.3, 4.4 towards 4.8. So that's a 40 basis point climb in 10-year yield. Dollar to rally, typically dollar does rally as a safe haven when the rest of the market sells off. So this dollar rally coming up could mean correlated with the market sell-off. And the SPAC activity, like we saw with VBull, like we're seeing with these meme stocks, are concerning. That kind of very sharp peaks are unsustainable. Expect pullbacks in the meme stocks over the next few weeks as the market pulls back. So in summary, let's just be very careful with the market, prepare for a pullback. And with that, good luck investing. We'll talk to you next week. Thank you.